Well, thanks all very much for being here. And also I want to thank the Info Shop for hosting this event. I think it's really wonderful. It's a great honor for me to be here and to be able to welcome Joe Stiglitz to the bank for this discussion of his new book, Making Globalization Work. Now, very often chairs will say that a speaker doesn't need any introduction. In this case, I think you'll agree it's really true. In fact, I actually tried to think of people who needed less of an introduction than Joe to the bank, and I actually couldn't think of anybody. So Joe really doesn't need an introduction. I think many of us know him very well. You'll know something about his background, and let me just mention a few points for the form of it. He was a winner of the John Bates Clark Medal in 1979. He's held professorships at Yale, Stanford, Oxford, Princeton. He's currently the university professor at Columbia University, where he's the chair of Columbia University's Committee on Global Thought. He also chairs the Brooks World Poverty Institute at Manchester University. He was the chairman of the Council of Economic Advisors from 1995 to 1997. And in 2001, as I'm sure you know, he was awarded the Nobel Prize for his analysis of markets with incomplete information. But of course, Joe has a greater claim to fame. He was also our chief economist and senior vice president in the bank between 1997 to 2001. And Joe is still involved with the bank. He is a member of the Chief Economist Advisory Council, a little group that meets periodically to discuss strategic research issues. And really, he's a wonderful, wonderful participant. I could go on, but just to mention a couple of other things, that this book follows several other books on the global economy that Joe has written. The last, I think, is Globalization is Discontents, which has been translated into 35 languages and has sold about 1 million copies. A book on the Roaring '90s, a new paradigm in monetary economics, a book on free trade for all. And before handing over to Joe, just sort of a personal comment on what a unique person Joe is. I mean, when I was trying to think about how I have seen Joe working, I sort of think of an analogy with the financial system, and that most of us are rather like banks. We take in deposits, we make a few modifications, we change the term, we change ideas a little bit, and then we come out with something which vaguely resembles what went in. Now, Joe is not like that. Joe is more like a venture capital company, as I see him. He comes out with a lot of very original ideas, many of which involve thinking about the situation or the world as it could be, not as it is. A very different model from the model of a bank. And I think naturally not every venture capital investment has to be successful, and many venture capital ideas will be controversial. And so Joe, of course, is controversial. And I think that's the great merit of having someone like Joe to come and speak to us today. So without saying more, let me hand over to Joe. Joe, thank you.
Well, thank you very much for that introduction, and it really is a real pleasure to be back here, and especially talking about this book. Two of the critical issues that I talk about in the book are really at the center of the concerns of the World Bank and have been for a number of years. Problems in globalization, governance of the global economy, and problems of inequality highlighted, for instance, in the WDR of a little over a year ago. The title of the book, Making Globalization Work, provides, in a sense, a short summary of the whole book. The statement, Making Globalization Work, first suggests that something's not working right now. And as many of you who know me know that, yeah, I don't think things are working perfectly. And I'm going to spend a few minutes talking about some of the major ways in which it hasn't been working, particularly in areas of economics. The second is a note of optimism that there are changes, reforms that can make globalization work, or at least work better, and particularly work better for the poorest countries and for the poor even in the more advanced industrial countries. Because while globalization has had some winners, it has also had many losers. And much of the concern in this book is about the impact that globalization has had on inequality. So the book, in a way, consists of first identifying some of the problems, diagnosing why we have such problems, diagnosing this from both the perspective of the macro picture, the overall international architecture, and from the micro picture, looking at the particular arenas, trade, intellectual property, natural resources, global financial markets, the environment. And then finally, on the basis of that kind of diagnosis, to try to come up with some prescriptions, some ideas, some small, some large, some that can be accomplished, I think, in a relatively short time, and are, I think, really in which there's already some progress, and some, I think, that will take a little bit longer. Let me begin by talking about some of the problems. In the beginning of the discussion, of the modern discussion of globalization, maybe 15 years ago, there was the hope that everybody would be better off. There was a view that sometimes put that a rising tide lifts all boats. And one of the sub-themes of this book is that a riptide can destroy a lot of small, ill-prepared boats. And that sometimes the way globalization has been managed is more akin to a riptide than a slowly rising tide. In fact, there's been a divergence between the most successful countries and the least successful countries. Inequality across countries and inequality within countries has been growing. And that globalization has played a role both in the successes and in the failures. Successes sometimes get overlooked, particularly by critics of globalization. I want to emphasize that there have been some enormous successes. China has been growing at 9.7% for 30 years, India at 5 to 6% for a quarter century. These are countries that have managed globalization, at least managed it relatively well. In the case of China, several hundred million people have moved out of poverty, even though there has been increasing inequality. Their successes have largely been based on globalization, access to international markets, access to international technology. At the other extreme are the countries at the very bottom, and they have not been doing very well, and there has been a divergence. And we see that even closer to home, there's been a divergence between the United States and our immediate neighbor to the south, Mexico. I was on the Council of Economic Advisors at the time that NAFTA was adopted, and while we thought NAFTA would have a relatively little impact on the American economy, the major argument we thought for NAFTA was that it would help Mexico, and that by helping Mexico it would reduce immigration pressure on the United States, and that would have some positive effect on the United States, which we anticipated. Immigration, illegal immigration, was already a growing problem. Well, 10 years after NAFTA, it's clear that rather than reducing the disparity between incomes in the United States and Mexico, those income disparities have increased. And I try to argue in the book that actually NAFTA was at least part of the reason. And it's particularly had an adverse effect on the poorest people in Mexico, because the United States retained, it was called, NAFTA is the North American Free Trade Agreement, but it's not a free trade agreement. That was just the name. If it were a free trade agreement, you could write down a free trade agreement in a couple pages. You would say, no barriers to trade and no subsidies. It would take maybe 2 or 3 pages. Those of you who have seen these international free trade agreements know that they go on for thousands and thousands of pages, so long that no one is able to read them. And that actually gives enormous opportunity for a lot of the corporate interests to stuff a lot of things in there, knowing that no one will actually read them until it's too late. And if I have time in the question period, I can give you some very dramatic examples in the case of NAFTA's Chapter 11 on investor protection, which was actually designed to reduce the scope for environmental protection. But one of the aspects of in which the NAFTA was not a free trade agreement is that America kept its corn subsidies. These corn subsidies reduced the price of corn by about 50%. The poorest people in Mexico are the corn farmers. So in effect, NAFTA reduced the income of the poorest people in Mexico by 50%. And no wonder then that it actually resulted in increased immigration pressure. In spite of the fact that we as economists think that we've been doing a lot of research for the last 25 years or longer, and therefore know more about how to manage economies, and in spite of the fact that as our advice gets listened to, there are better market institutions around the world, actually growth hasn't been doing that well in developing countries. The region of the world that has perhaps paid the most attention to the, quote, advice coming from the advanced industrial countries has been Latin America. And Latin America in the 90s grew at a pace just over half of what it did in the 50s, 60s, and 70s before they learned how to manage their economy. In the case of Brazil, the numbers are, of course, more dramatic. Brazil had growth of 5.7% for 75 years before 1980. Now, they're happy if they can get 3% growth. And one of the saddest things that I've seen is the lowering of aspirations, of expectations, as a result of this, if now almost a quarter century of modern globalization in which growth has not been up to what one would have hoped. By the same token, one would have thought with greater knowledge, better market institutions, there would be fewer crises. But in fact, as research here at the World Bank has shown, there have been about 100 crises in the last 3 decades, that it's more unusual for countries, developing countries, not to have had a crisis than to have a crisis. The only major emerging market countries not to have had a crisis were India and China, both of which did not go along with the standard wisdom of capital market liberalization. And one would argue it was because they didn't go along with that they did not have these crises. There are other aspects in which globalization is not working in the way that economic theory would have, one would have expected, the advocates of globalization had predicted. If you saw a world in which water was flowing uphill, you'd say something's very peculiar about that world. Well, in economics, the same thing. If you see money is supposed to flow from rich countries to poor countries. But in recent years, money is often moved from the poor countries to the rich countries. And that's part of the reason why growth has not been as strong. One of the reasons that money has been flowing from the poor countries to the rich is the large number of countries that have overbearing debt problems. If you saw only 1 or 2 countries with a debt problem, it would be easy to blame a profligate government. We all know examples of countries that went from, for instance, a 2% surplus of GDP to a 5% deficit in the space of a couple of years as a result of bad economic management. And so we know how poor government can have a very big effect in a very short span of time. But the problem with debt is that it's not just 1 or 2 countries, but it's many countries all over the world that have debts beyond their ability to manage. And one of the reasons for that is another peculiarity of the global financial markets. In spite of the fact that financial markets talk about their ability to shift risk from those who are less able to those who are more able to bear their risk, their ability with derivatives to slice and dice risk, in fact, it's still the case that the developing countries disproportionately bear risk. They borrow short-term in hard currencies, and so when interest rates change or exchange rates change, debts that are moderate can quickly turn into levels that are beyond a country's ability to manage. Well, as I say, these are just a few of the ways in which globalization has not turned out in the way that its advocates hoped. Well, what are some of the underlying problems? Well, I want to identify very quickly four overarching problems. The first is that, to put it in a fairly brief terms, is that economic globalization has outpaced political globalization. Economic globalization has meant that the countries of the world are more integrated. More integrated means that they are more interdependent. As they become more interdependent, there is a greater need to act collectively, to act together. But we don't have the institutions, the political institutions, the democratic political institutions, or the mindsets with which to act together in a global way. I saw that very clearly when I was when I was at the Council of Economic Advisors. When we talked about domestic economic policy, we would always talk about issues of efficiency and issues of equity, fairness. But when it came to international economic policy, we changed the mindset completely. When we told our trade negotiator, which for the United States is called the USTR, U.S. Trade Representative, when he went off to Geneva to negotiate a trade agreement, we didn't say, come back with a fair agreement. He would have been fired. He was told, come back with the best deal for America, or more accurately, a best deal for our campaign contributors. We didn't actually say that way, but that was the understood, what was understood about what his job was. And that's what he did. One of the topics I'm going to talk about a little bit later is intellectual property. When they went to Geneva, he argued for an intellectual property regime which both the Council of Economic Advisors and the Office of Science and Technology Policy thought was unbalanced. We thought it was bad for American science. We thought it was bad for global science. We thought it was particularly bad for developing countries, both for their access to knowledge and access to life-saving drugs. But that wasn't what drove American policy. What drove the policy was the entertainment industry, and more forcefully, the pharmaceutical industry, whose view was very simple. They wanted the strongest intellectual property provision possible. And what they really meant, in case of drug companies, they wanted to squash generic medicines. They wanted to delay the introduction of generic medicines as long as possible. And they got what they wanted, and I'll come to some of the consequences of that. These problems were made worse by the end of the Cold War. In many ways, the end of the Cold War was a great thing. But one of the things the Cold War meant was that the United States, during the Cold War, had to compete for the affection, or at least for the allegiance, of the developing countries. One of the adverse effects was that we took the position that the enemy of our enemy was our friend, so we befriended people like Pinochet. We gave money to Mobutu, knowing that that money was not going to help Congo, but wind up in a Swiss bank account. With the end of the Cold War, we had the opportunity to try to reshape globalization to reflect our principles and values, but we also had the opportunity to try to reshape globalization, reflect our own interest, unfettered by competition, unfettered by worrying about allegiances to anybody else. And unfortunately, too often we took the latter course. And again, you see that very clearly in the trade agreements, probably more clearly than anywhere else, where in the Uruguay Round Agreement that was signed in 1994, just a few years after the end of the Cold War, it was so unbalanced that the poorest countries of the world were actually worse off. It wasn't just that they got a smaller share of the gain. Everybody expected the United States and the EU to walk off with a larger share of the gain, but they were actually worse off. And they were worse off because of the asymmetries in these trade agreements. The advanced industrial countries forced the developing countries to open up their goods to their markets to their goods, but the advanced industrial countries didn't reciprocate, particularly in the area of agriculture, which is critically important for developing countries, with 70% of the population depending directly or indirectly on agriculture. That's not the only asymmetry. Another asymmetry was asymmetry between the focus on capital, market liberalization, opening up markets for investment, free flow of capital, and labor, temporary labor, migration. If you looked at it from the point of view of global efficiency, it's unambiguously clear that even a little bit of liberalization in the area of labor will have far more gains to global efficiency than liberalization of capital. So if you were asking what is more important for global efficiency, you would focus on labor. And if you were asking questions about what's important for development and global equity, you focus even more on labor. Importance of migration, temporary migration, has been heightened in recent years by work at the World Bank, focusing on remittances, which have now become more important in some countries than foreign direct investment. Well, this asymmetry between capital and labor has enormous consequences, not only for the rich countries and the poor, but also between capital and labor all over the world. Because it means that in bargaining and taxation, if one threatens to regulate or to tax capital, it can move anywhere in the world that it wants. If you threaten to tax unskilled labor, it has no choice. And the result of this is that this asymmetric liberalization has contributed to the increasing inequality that is observed all over the world. The final important reason for some of the ways that globalization has not worked out as well is that we've had this Pollyannish view that everybody would benefit. I began with that, talking about how in the beginning of the recent discussions of globalization, the view is that everybody would benefit. And that was why when the protests broke out in Seattle in December of 1999, at the beginning of what was supposed to be a new round of trade negotiations, many economists were puzzled. Some of them said it was really a problem not for economics, it's a problem for psychiatry. Why was it that people were better off and not happier, or at least they didn't know it? But of course, as I mentioned before, studies at the UNDP and the World Bank have shown that the poorest countries were poor and that there were poorer people within the countries. And so they were unhappy because they should have been unhappy. Well, actually, standard economic theory had long predicted that there would be losers. One of the results that any of you who've taken the basic graduate course in economics have studied is the Paul Samuelson, who was my teacher, factor price equalization theorem, which said that complete global integration would lead to the equalization of factor prices all over the world. That would mean unskilled wages in the United States would be the same as unskilled wages in India or China. And what he showed was even stronger, that you didn't have to have full integration, you didn't have to have full mobility of labor or capital, that trade was a substitute for full integration, and that even some degrees of trade globalization would unleash forces that would lower the wages of the unskilled workers in the advanced industrial countries. Now, like any theorem, there are assumptions that go into that theorem. One of the assumptions was that there was the same knowledge, the same technology everywhere in the world. And that was clearly, at the time he wrote that paper, not a very good assumption. But today, it's a much better assumption. And one of the accomplishments of modern globalization is that it has actually equalized knowledge across the countries, moved in that direction. We're far from full equalization, but we've moved much closer in that direction. And in fact, that is one of the thrusts of the World Bank, of talking about being a knowledge bank, of closing the knowledge gap. And it's the knowledge gap that's one of the most important factors separating the developing and the more developed countries. So as this process goes on and knowledge gets equalized, that means this prediction of what integration would mean is coming more and more true. And the result of that is that it's increasingly apparent that in the advanced industrial countries, there may be significant numbers of losers. As I say, the standard theory never said that everybody would be a winner. It only said that the winners would win enough that they could compensate the losers. But it never said that they would. And the problem is even worse, because globalization is used as an excuse for taking away a lot of the social protections, as an excuse for changing the tax structure against those who are already losing. So when the young French workers last spring went on protest saying, you know, our wages are being cut, our job protections are being cut, and the response was, well, this is what you have to do to respond to globalization. And then they were said, but by the way, globalization is going to make you better off. They scratch their heads and they say, how does lower wages and less job protections make us better off? And then the answer comes, well, you have to be patient. And of course, every economist knows the response to that is the Keynes's famous quip that in the long run we're all dead. And the point is, the length of time of what we're talking about here, at the very least, is a long time. Real wages at the bottom in the United States have stagnated for 30 years. In fact, real wages at the bottom are 30% below what they were 30 years ago. So that's a working lifetime that people see that their income is lower than their parents'. Even in the middle, the United States, median income in the United States has fallen over the last 5-6 years. So it can even be the case that most people can be worse off. Yes, there are some very big winners, but more people can be losers than the winners. And the response, of course, is that if we are going to make globalization work, that we have to recognize that there are these losers from globalization, and that we have to design policies, investments in education, health, technology, more progressive tax systems, better safety nets that respond to this. Now, some people say, well, you know, globalization is inevitable, almost like it's a pill. It's unpleasant, like cod liver oil. You just have to get used to it, accept it. But that's not true. The pace of globalization, the extent of globalization today is weaker. The extent of globalization was stronger before World War I than it was in the interwar period, measured by, for instance, the ratio of trade to GDP or capital flows to GDP. There can be a backlash against globalization if it is the case in our democracies a majority of the people are worse off. Now, of course, globalization is only one of several forces leading to these growing inequalities. Technology, there can be changes in social norms, weakening of unions. There are a whole host of forces that may be contributing to this pattern of globally increasing inequality. But globalization is something that citizens feel that they can do something about. They may not be able to change the pace of technology, the direction of technology, but they can do something about globalization. They did that in the interwar period with the passage in the United States of the Smoot-Hawley tariffs. And that, again, unless we make globalization work better, we risk that kind of a backlash. Now, most of my book is devoted to looking at a large number of very specific problems and trying to make very specific proposals in each of the areas: trade, financial markets, intellectual property, the environment, natural resources. What I want to do in the limited amount of time here is pick up a couple of these topics, as many as my time allows, and just in a very brief form, try to describe the way in which my analysis differs from some of the more popular discussion, and suggest some reforms that might make globalization work better. Let me begin with intellectual property, because knowledge is so important for development. When I was the chief economist of the WDR in 1998, focused on the role of knowledge and information in development. And some of the issues that I talk about in this chapter, the discussion of those issues began in that WDR. Obviously, as an academic, as a producer of intellectual property, I have a certain sympathy for intellectual property. But also, let me try to explain a little bit the ambivalent feeling I have, illustrated by a couple examples. In the mid-1980s, I got a letter from a Chinese publisher who wanted me to write a preface to a pirated edition of one of my books. And actually, I was rather enthusiastic, because my view was if only 1/100% of the people in China read the book, it's a big audience. And when you write it, you don't really write for money. You write for trying to have your ideas have influence. And so for me, this was a great opportunity. But before writing it, I decided I better check with my publisher. And he went ballistic. Another story that illustrates my ambivalence was around the same time I was in Taiwan, and I had a little free time to go down to a bookstore, and I had heard that I knew that Taiwanese publishers were often pirating books. And as I went down there, I went through in my own mind a little debate about whether I would be unhappier if they had or had not pirated my book. If they had pirated my book, of course, they were stealing intellectual property. But if they had not, they were ignoring me. And by the time I got to the bookstore, I decided that I actually would prefer it if they had stolen my book. And they actually had, so I felt relieved. Well, intellectual property is different from ordinary property. The function of ordinary property is to increase efficiency. Property rights are designed, you've probably heard this whole shtick about property rights and increasing efficiency. But intellectual property creates a very large distortion. Knowledge is like a public good. Thomas Jefferson, if you have time, go over to the Jefferson Memorial. It's on the wall there. Thomas Jefferson put it very aptly, much more eloquently than economists who talk about non-exclusivity. He put it the following way. He said that when one candle lights another candle, it doesn't diminish from the light of the first candle. Economists' use of non-exclusivity just means the marginal cost of another person using it is zero, and that means any restriction of the use is an inefficiency. But intellectual property is even worse. Not only does it restrict the use, it gives monopoly power. And we all know that monopoly is a bad thing. Well, why do we tolerate, actually encourage this kind of monopoly? Well, the argument is that we do it because it has a benefit. The benefit is supposedly to lead to more innovation. But if you don't design intellectual property right, it can actually lead to less innovation. Now, designing intellectual property is a complicated thing, but there are many terms that go into the design of intellectual property, What can be patented? Most important ideas cannot be patented. For instance, sometimes I think, wouldn't it have been nice if I could have patented the idea of asymmetric information? I would be a wealthy person. But you can't patent even as an idea as important as that. You can't, the most important ideas in physics, Einstein couldn't patent his ideas. So the most important ideas, basic science, cannot be patented. And I think that's a good thing, because the general usage is so much more valuable than the restrictions. There are other aspects of what determines, what novelty, whether it's novel, the breadth of the patent. There are a whole host of provisions that determine the nature of the intellectual property regime, and what you're trying to do in designing an intellectual property regime is balance the cost, which is the monopoly and the inefficiency, with the benefit, which is the incentive for the innovation directed in the right way. If you don't do it right, you have all the cost and none of the benefits. And unfortunately, in the WTO agreement, the TRIPS agreement, it's called trade-related intellectual property, it has nothing to do with trade. It was just called trade-related because they wanted to stuff it into the 1994 Uruguay Round Agreement. There was already a World Intellectual Property Organization, but they wanted to use the enforcement mechanism of trade. So they stuffed it in and called it trade-related intellectual property, tried to impose an American-style intellectual property regime on the whole world. And it was clearly, as I said before, bad for American science and global science, and even worse for the developing countries. At the time, there was very little discussion of how bad it was. Fortunately, more recently, people have become more aware of it, and at the WIPO meeting a little over a year ago, there was a decision pushed through by Brazil and Argentina to try to think about what a development-oriented intellectual property or regime would look like. Well, even the United States recognized that an unbalanced intellectual property regime could have a very negative effect on innovation. And we've seen that in the last century. The two most important innovations in the last century were automobiles and airplanes. And both of those were almost squashed by our intellectual property regime. Someone got a patent on the four-wheel self-propelled vehicle. The fact that that Daimler already had the idea in Germany was of no relevance to the Patent Office of the United States. He didn't know about it, just like he didn't know, the Patent Office of the United States didn't know that people have been eating basmati rice for a couple thousand years before he granted a patent for basmati rice to a Texas company. The U.S. Patent Office also granted even a more interesting little digression, but gave a patent for the healing properties of turmeric. And the applicant were two doctors from India who, of course, in India, they've known about this for hundreds of years. So they didn't disclose, of course, that he learned this at his grandmother's foot, but that he got the patent, and others who want to use that have to pay him as a result. Well, got a patent on the four-wheel vehicle. The idea was not that he wanted to innovate. What he used the patent to do was to form a cartel to raise the price. And most of the other producers, all but one of the producers of automobiles thought this was a good idea. You know, everybody likes monopoly because that's the best way of ensuring high profits. Well, there's one innovator who had a different vision, and that was Henry Ford. Because his vision of an automobile was a people's car, low price, available, that would transform the transportation system. And he had the determination, the fortitude, and the resources to fight the patent. It takes a lot of resources to fight the patent. It's a public good, because if you succeed in fighting the patent and destroying it, anybody can enter. So there's going to be an undersupply of the provision of this public good of fighting bad patents. And he won. And the result is that if he had lost, the development of the automobile as we know it would have been forestalled for a long time. Now, given the concerns about global warming, maybe that would have been a good thing. But obviously at that time, people had not read the earlier literature on global warming, and so were not aware of this problem. The airplane has a similar problem. You all know about the story of the Wright brothers at Kitty Hawk, 1903, got a patent. But there was somebody else, Glenn Curtiss, who got a patent. And as so often happens, you have these interlocking patents, which is called a patent thicket. They both demand that anybody who wanted to develop the airplane pay them both. And with both of them demanding it, nobody could afford it. And the development of the airplane was arrested until World War I, when the United States said it was too important for fighting the war to have an airplane. They weren't going to let the lawyers stop them anymore. And what they did is the government just basically seized the patents and formed a patent pool and said, we'll determine how much everybody pays and how much everybody gets. We're not going to leave it to the patent system. Today, there's a similar kind of problem in software. Thousands of patents every year. The likelihood that if you write a good program that you trespass on somebody's patent is very high. If you spend all your time reading the patent applications, you don't have any time to do research. And you all know the story of BlackBerry that was held to ransom $600 million for a patent that was already declared invalid in Germany and the UK. But the US Patent Office had not yet gotten around to declaring it invalid, and therefore, so long as it was valid, they could shut down BlackBerry and get a $600 million ransom out of them. Well, for the developing countries, what we're talking about is not just a question of money, it's a question of life and death. When they signed that agreement in Marrakesh, the trade ministers were in effect signing the death warrants on thousands of people in sub-Saharan Africa, because with generic medicines no longer available, most of the people in those countries could no longer afford access to medicine. At the same time, the developing countries haven't gotten much benefit. The drug companies spend more money on marketing and advertising than they do on research, more money on research on lifestyle drugs like hair and other things than they do on life-saving drugs. And on the life-saving drugs, almost all of it goes to the diseases of the advanced industrial countries, none of them to diseases like malaria, the other diseases for the poor countries. There is an alternative, one that actually people have talked about for a long time, and that's to have a prize fund. In other words, you create some prizes. Those who come up with a vaccine or a cure for malaria or one of the important diseases get a big prize. Those who come up with a Me Too drug get a small prize. That will provide incentives. But then you use the market, competitive markets, to distribute the goods, to produce the goods. And so the model, you might call the business model, rather than monopoly, which is based on high prices, low output, is low prices, large output. And this is particularly important when you're dealing with life-saving diseases. Let me talk about a second example, just very, very quickly, and that has to do with global warming. The reason I spend time on global warming is that it's both emblematic of the failures of globalization, global governance, but it's also, even if we solve the problems of economic globalization, if we're all frying, it's not going to do us a lot of good. This is another area where the impacts are disproportionate. Countries like Maldives, the low-lying islands in the Pacific, will no longer exist within 50 to 75 years. Bangladesh, a third of the country, will probably be underwater. I was at a meeting at Davos last January, where some of the oil executives said, you know, you really are too gloomy. You should look on the positive side of the opportunities that global warming is bringing about. The Arctic ice cap is melting. I don't know if you're following this, but melting very rapidly. And they went on to point out that that would mean they'll be able to get the oil underneath the Arctic Sea at a much lower cost than previously. The only problem is that the United States has not signed the law of the sea, so there might be a little bit of conflict of who gets to, whose oil companies get this particular oil. I don't know whether they're thinking about a war, but certainly the Kyoto was a major step forward in some ways. At least there was a global agreement, but it left out actually something like 3/4 of the problem. The United States, which about 20–25%, didn't join in. The developing countries, which within 30 years will be about 50%, didn't join in. And there was nothing done about deforestation. And deforestation contributes about another 20%. So we're talking about, in terms of coverage of countries and sources, about 3/4 of the sources of global warming have been left out. And what I try to do in this book is to present some concrete proposals of ways to resolve these three major gaps. One involving trade sanctions to make sure that all countries participate. Trade sanctions were used in the Montreal Convention for the ozone-destroying gases that allow radiation causes skin cancer. That worked. And I point out that the United States actually argued for the right to use trade sanctions in the case of environmental issues. It barred the importation of shrimp from Thailand that were caught in nets that caught an endangered species of turtles. Of course, Thailand objected, but it went to the WTO appellate, and they sustained the United States' view that environment was more important than trade. I asked one of the appellate judges, did he understand the full implications of that? What that meant for global warming? And he said he did. What it means in particular is, you know, the United States says that it can't afford to have to do anything about global warming. That's obviously nonsense. The United States has emissions twice the level of other countries of comparable standards of living. So clearly it's not a question of affording, it's a question of getting an unfair competitive advantage. The United States is not paying one of the most important costs of production. The cost of production is the social cost of these emissions. And that gives it an advantage. WTO is supposed to create a level playing field. Subsidies of this kind, this is an implicit subsidy, are barred. And the U.S. argument was a compelling argument for why sanctions should be brought against itself. It didn't think about it in that term when it brought the case against Thailand, but that is clearly its proposal. One of the things the World Bank is recently getting involved in is the Rainforest Coalition Initiative. The developing countries, the rainforest countries, are involved in carbon sequestration, taking carbon out of the atmosphere, storing it. We know the value of their contribution because we know the value of a ton of carbon. Carbon is now traded in the European trading system, and in effect, the developing countries today, the rainforest countries today, are providing these global environmental services for which they are not being compensated. And the value of these services is in fact greater than the foreign aid they receive. And the Rainforest Coalition is trying to put forward a proposal, and we've succeeded so far in getting it actually onto the agenda, that would provide compensation for their providing these environmental services. Costa Rica has shown how you can do it in a way that provides incentives, market-based incentives for people to use their land in the globally most efficient way, which include, it means planting forest in many cases. And what we're hoping to do is to expand this onto a global scene. Finally, what I was going to talk about, and I've run out of time, is something about mentioned about the global financial markets. Let me just say just one word. It's clear that there are enormous volatility, global imbalances, not sustainable. The U.S. Borrowing nearly $3 billion a day from poorer countries while lecturing them about living within their means. The problem, I argue, is that we've been focusing on the symptoms like an undervalued exchange rate in China. Focusing on symptoms doesn't get at the underlying problems. In fact, if China were to change its exchange rate and the underlying problems, including America's fiscal deficit, is not solved, actually global instability, financial instability, would increase, not be reduced. The underlying problem I attribute to the global reserve system. The world has gone through several failures already. The gold system failed, the sterling system failed, the Bretton Woods system, the fixed exchange rate system failed, and we are now watching the failure of the flexible exchange rate dollar-based system. It's fraying. There needs to be a more fundamental reform, which I link back to an old idea of Keynes and show how it can be adapted to the modern era. Let me conclude by saying some of the reviews in my book have said that to put it in a gentle way, that I'm excessively optimistic. That I hope that there will be an unprecedented breakout of multilateralism. Somebody put, giving a sermon about what's wrong, I explain the role of special interests. Why do I think, having given the sermon, anything will change? And I think the answer is, to put it very briefly, is there will be changes. They are going on. Globalization is a dynamic process, and there will be changes. The dollar system is fraying. The dollar reserve system is fraying. The Brazil brought a case against the United States, the WTO, on the cotton subsidies and won. The developing countries have taken a different posture in the trade negotiations. Civil society has become very active on issues of debt and intellectual property. Global warming, the U.S. government can pretend that it doesn't exist, but it does, and we are seeing the consequences of it. All of these things are changes, the increasing role of China. All of these are changes that are going on in the way our global economy and our global society is working. So there will be changes. The only issue is whether we respond by lurching from one crisis to another, from one patchwork to another, or whether we try to understand the reasons, the ways in which globalization isn't working, and try in a more rational, more thoughtful way to fix the problems before we have a crisis. And really, this book is written in the hope that the world will take the latter course, in which the international financial institutions, like the World Bank, have a very important role to play. Thank you.
Thank you very much, Joe. I know that Joe is very keen to hear your questions and your views, so I'm going to be brief to allow some time at the end. It's impossible to dissect every aspect of a book like this anyway. It contains such a wide variety of issues. When I read the reviews of this book, a couple of things struck me. First, as I said, a lot of differences in terms of how people have seen this book, but also that much of the discussion has not focused actually on the specific issues that Joe has mentioned, that often it has been relating to the particular presentation or discussion of economic systems, and that very few of the reviews that I've seen have actually looked in depth at the kind of proposals which are coming up here. And I think that that's a pity, because when I read the book, I learned a lot, and it made me think about a whole range of these global issues. And it does so because it has lots of examples. The book is great on examples. It has examples of everything, and that makes it a very human book. First of all, on the view of globalization, a couple of comments. I agree very much with two central propositions that are made. The first is that economic globalization has outrun political globalization. I think that is very true in many dimensions. And there are other pieces of work that look at this from other perspectives. If you look, for example, at the book by Illicit by Moises Naim recently, he addresses this issue from a somewhat different perspective, which is the difficulties that national governments face in dealing with trans-border crime in the current environment. Secondly, the proposition that the global system, whether in trade policy or in the way in which it handles intellectual property rights, the contrast between global mobility of capital and immobility of unskilled labor, is generally tilted towards the interests of rich countries and particular constituencies within these countries. And I think that is also very true. And the book gives lots of examples, as I've said, and one can think of others. And I think one of the things this brings out is the importance of the bank's advocacy role in these areas. We are engaged, as Joe has mentioned, in many of these areas, including on trade, including in areas relating to the environment and so on, including in trying to bring out the importance of concepts such as equity to underpin the operation of a successful economy and so on. And I think part of our job has to be to try to find out where we can find common interests against special interests. And so the bank's work, its advocacy, its research, its operational experience are very important parts of this process of bringing things to the fore. And sometimes we see that things can change very quickly when the interests of important stakeholders change. I was very surprised, for example, how after years of having had it drummed into me when I was chief economist in the Africa region, that HIPC was absolutely, totally, and completely the last debt relief initiative that would ever be considered, how suddenly it became in the interests of major shareholders to grant a further round of debt relief, which I think took us all by surprise. So things do change. Maybe the resolution of the Iraqi debt had some role in that, Joe, but you see what I mean. So part of the question is, how do we find partners and causes here? I do think one needs to be careful in terms of balancing the advantages of globalization and the problems of the system with the other problem that many of the difficulties associated with rising dispersion in global incomes, I think, stem not particularly from globalization, but from the difficulties that some countries have for internal reasons of taking advantage of the opportunities that even the imperfect global system provides. And I think particularly at the bottom end of the performance spectrum, this is very much true. Africa is probably quite a good example here. There are all kinds of ways in which the global economic system, I believe, works against the interests of Africa. But nevertheless, what you will find is that the problem is less, I think, the external system than the fact that countries are being outcompeted by other developing countries, often with no better access, or perhaps worse access, and with worse opportunities, but nevertheless more able to negotiate the global world successfully. So I do think that that balance is an important one. Turning to some of the systemic reform proposals, I'll just be very brief on a few of them. I very much agree with most of the observations, particularly on trade. I think the complexity of the international trade regime is quite extraordinary, even if one looks at the fine print in something like the AGOA program, which gets down to the precise make of cloth that has to be in certain products for them to be. This really doesn't make sense. And I think a radical simplification would be very much desirable. The way that rules of origin work. I think on the intellectual property rights also the book makes lots of very valuable observations, particularly in recognizing traditional knowledge and prohibiting biopiracy. Clearly, in cases where the knowledge exists and where the basic elements exist, the onus should be on the applicant for a patent to show that there is global value, global innovation value, before being able to be granted any form of patent. And I've seen in some other examples from my own country where items which are very commonly on the shelves with very common names have received patents in the US, which can only restrict the marketing and the value of these products. So I agree very much with what Joe says. On the other hand, there are some areas where we may have to be very careful. One, for example, is on labor standards. And I think that kind of area we have to be careful because, for instance, of the potential for the use of such global standards as a protectionist device. On global warming, the book is very interesting, and it makes a number of very insightful comments on the Kyoto, and it proposes an alternative which is a simple uniform tax on carbon emissions levied by individual countries. And I must say, when I read the book there, I sort of scratched my head and thought, gee, yeah, this is probably how we would do it. If it was a single country worrying about emissions, you know, a kind of government wouldn't come and tell you how much you could heat your house. And what they would simply do is tax the fuel, tax the emissions. And this has a number of other nice features, too. The more of an emitter you are, given your level of income, the more of these taxes you will have to levy. But presumably you can use the revenue from these taxes to reduce other taxes, so you're really just tilting the balance between different activities rather than disadvantaging whole sectors of your economy willy-nilly. A very interesting discussion there. Might be very difficult. While Europe, for example, is able to tax gasoline at very high levels, it's interesting the US has not managed to build political consensus for such taxes. Another area which is flagged is the issue of dealing with sovereign debt. And here I think, again, the book is quite right, that it is a great pity that the initiative of the fund to develop a sovereign debt restructuring mechanism was cut off in favor of a collective action clause, which I think is very uncertain as to how this will work when it comes to be tested. And it's interesting that the book suggests less borrowing and the use of some innovative instruments, for example, commodity-linked or exchange-rate-linked instruments or borrowing in local currency. And one does wonder a little why such innovations, such as, let's say, oil-linked bonds, have not come into much more general use than they have. So we might wonder why spontaneously markets have not developed some of the instruments that they could develop to share risk better. I think some of the more difficult areas are those that would require both a lot of global agreement and sophisticated technical implementation. And that is a question, I think, that one can raise about some of these questions. How would implementation arrangements actually work, and what kind of global agreement would they need to bring on? For example, the issue of a global competition policy. Implementing global competition law would seem quite a difficult objective. Another very complex area discussed is the question of how multinational firms should be dealt with in terms of pollution. Should they be subject to their host country legal systems? And if they choose not to be subject to host country legal systems, should they have the option of being subject to their home country legal systems using home country environmental and social standards? And I think here the thrust of the book is to propose that standards should be uniform across countries, that simply working in a poor country should not create a double standard. And the issue that I see here is that in many countries, developing countries, the standards of the rich countries are simply not the standards that the countries see as in their own interests. And so one there might run the risk of imposing a kind of imperialistic global standard on countries which don't have the same priorities. For example, in trading off biodiversity versus electricity. So these are very complex areas, and I think in some of them we can have some debate going forward. I think I've said enough just to reinforce the point that there are a lot of very fascinating issues in this book, and also they're real and they're important issues. And Also to note that we have a very important role in terms of helping to mobilize constituencies for areas where we feel some progress can be made in a number of these dimensions. Let me stop there and open up to questions. I'm sure Joe will be delighted to take questions. Please indicate your name and let's go. Yes, one, please. Can you go to the microphone? Do you want to come up here? Yeah, take a few together. Would you like me to chair from here, Joe?
Hi.
Okay, you go here and I'll chair.
Thank you very much for your talk. My name is Asif Ansar, consultant here at the bank in Africa region. If you could help us understand debt relief a little better, please, because the way I understand it, even though a lot of the debt of, say, poor nations, say, in Africa have been waived, the net revenue effect on these countries is zero, isn't it? Because, for example, if you're the finance ministry in Mozambique, you're paying X million dollars back to the United States in debt servicing, but you're getting X million from the World Bank or IMF, a certain program lending. Now that your debt's been reduced, that money from the World Bank is not necessarily going to you any longer. So how do you then, sort of put forward any social programs in Mozambique or Madagascar, other countries? Thank you.
Maybe we can just take a few questions together and let them be answered. Would anyone else like to introduce a question at this stage? Floor's open.
While they're thinking of questions, let me answer that and respond to a couple questions that points you raised. Yeah, the problem. There are two issues that I deal with. One is how do we handle debt relief and how do we prevent the problem of debt, the burdensome problem of debt arising again. In terms of debt relief, what you raised was one of the real concerns at Gleneagles when they had debt relief, where the worry was that the World Bank would have to pay for the debt relief. And so it was essentially the poor paying for the very poor, so that the World Bank would have less money to give out in loans because they expend that money in debt relief. There was also a worry that there would be actually less of a flow from the developed countries to the developing countries, because some of the debt relief is debt that would never have been paid anyway. That is to say, there were a number of countries who owed money, had no intention of ever repaying it, and it was all an accounting thing. The developed country said that you don't have to pay us, and of course they said, well, we were never going to pay you anyway, and so everybody could feel a little bit better. There was one case of a country that got debt relief and had to put several $billion up front, which is probably more than it would have otherwise had even paid. And there was some debate about that, whether that was debt relief or whether that was getting more money from these poor countries. Well, I think the bottom line out of all this was that there was pressure on the advanced industrial countries to actually make this a meaningful gesture, not just that they would actually they would replenish the World Bank for money that the World Bank hasn't that the money the World Bank was putting out for debt relief, that they would not really reduce their aid flows by effect counting money, this debt relief as part of aid in a way that they shouldn't have. It is a little too early to know whether those commitments will actually be realized, but it's clear that there was a lot of discussion of this, and certainly the rhetoric or the pronouncements have moved in a positive direction. And I just think it's a little bit too early to know. Alan may know a little bit more about where. What? Yeah, I think that's the best way of describing, waiting to see whether, in fact, it will make. What? The second issue is how to prevent it from occurring. And there, I think, there are two issues are how do we shift risk away from the developing countries to the developed? And those were some of the things that Alan talked about, better instruments. Some of this is already going on. In Asia, was an attempt in Thailand to create an Asian bond fund so that, at least in the area of exchange rate risk, the Asian countries would not be so dependent on borrowing in dollars. And in Asia, there was a real sense of irony, because their view was they were the source of global saving. Here they were taking their savings, shipping it to the United States or Europe, and winding up bearing the risk. And they were sort of scratching their head, this doesn't make sense. And there was an agreement to try to do something about it. It's still nascent, but it's beginning working. It's actually in Asia that the precursors to some of the reforms of the global reserve system that I talk about are also taking place. There was an agreement, was called the Chiang Mai Initiative, of an exchange within Asia of their reserves, so that they would hold less dollars in their reserves and they would hold each other's currencies in their reserves. So in a way, this is a precursor of the kind of idea that I talk about of a global reserve system, not based on dollars, but on a more widespread of a multilateral system. There were two things that Ellen, that you said that I wanted to pick up. The first was on the role of advocacy. I think that is very important, and the bank has taken a very large, very open role, and I think an effective role in the area of trade. But there's some other areas where I think it could take a more active, open role. One of them, for instance, is you probably have heard. There's a lot of concern about corruption, and the question is, can we do more? The international community do more to circumscribe the opportunities, the incentives for corruption? I think the answer is unambiguously yes. Let me just give you one example, two examples. One of them is bank secrecy. When I was at the World Bank, we got into this issue because in the East Asia crisis, everybody said problem with transparency was at the root of the problem. It actually wasn't, but that began the discussion of transparency. And then somebody said, well, if we're going to have transparency, we ought to, you have to have transparency globally, not just in East Asia. And at that point, some people in the U.S. Treasury said we didn't mean that kind of transparency. We just meant transparency for the developing countries. Well, actually, the OECD took this rather more seriously, and they had made an agreement for restricting bank secrecy. Bank secrecy is really important because it's through bank secrecy that a lot of the corruption gets mediated. If you're a corrupt leader in a country, you steal your money, you put it in the Cayman Islands. I don't want to accuse them particularly, but you put it somewhere like in the Caribbean. You ask the question, why has that become a major banking center? Is the climate particularly conducive? It may be good for growing sugar, but is it particularly good for banking? And no, the answer is no. You can do banking just as well, in fact, maybe better inside and in cold climates in London and New York as you can in a warm climate where you would rather be outside. So there's no real physical attribute that makes the Cayman Islands a good place for banking. It's there because people are avoiding regulations. That's why they go there. Everybody knows that. And it's very convenient because you put your money there, you get overthrown by a democratic revolution, and you can go and have a nice vacation, permanent vacation, have your money right nearby. So everybody understands this. The there was an agreement to do something about this, to reduce the scope for bank secrecy, expand not only for corruption, for drugs, for money laundering, tax evasion. And the United States, in August of 2001, vetoed it. And of course, after that, in September 2001, they realized that bank secrecy was also the vehicle through which terrorists get funded. And they have since shown that they can stop bank secrecy when they care about it, for terrorists. But they haven't done anything about terrorism, about corruption. I tell a little brief story. I was in one of these safe havens. I don't know why they invite me to these, but I went there and I gave my sermon about how bad they were and the evil that they are doing, the cost to the developing countries. And at the end, I obviously had some emotional effect on a few of the bankers. They came up to me and they said, you know, we're not as bad as you say. We don't do money laundering. We don't do drugs. We don't do corruption. We don't do terrorism. We only do tax evasion. And I asked them, how do you know this? And he came back and he said, because we asked them. Well, the point is that I think that this bank secrecy can be handled in a way that's consistent with principles of privacy and principles of good commerce. And the bank secrecy has a very debilitating effect on developing countries. The bank ought to take a lead role in doing something about it. Another example is the Extractive Industries Transparency Initiative. It's not an accident, the phenomena called the resource curse, the fact that countries with more resources grow more slowly. Part of the problem is this corruption. And as one person once said, sunshine is the strongest antiseptic. Bringing things out into the open is a strong antidote. And there's a big initiative. Nigeria has actually been very active in actually doing this. Ngozi, who used to be one of the vice president, country director for Malaysia here. But most of the other countries have not done this. Some companies have played a very important role. BP Hydro in Angola said we want to have transparency so people know what their government is getting. And the Angolan government responded and said, if you do that, you're out. And the other oil company said, we do whatever Angola tells us. Clearly, the advanced industrial countries can do more in a very easy way, and that's one of the proposals in the book. All they have to say is you can't get any tax deduction for any payments that are not transparent. It's hard to believe, but 10 years ago, several countries used to give tax deductions for bribes. You say, you know, I paid a bribe to the government official, $100,000, and in effect, the U.S. government, or whatever government was, it wasn't the U.S. because we stopped this in the 70s, but other countries were doing this. The government was in effect paying half of the bribe, because with tax deduction, it was in effect the government, it meant the cost was being borne by the public purse. And when I was the U.S. representative to the ministerial of the OECD, was one of the things that I helped push through was this stronger action against anti-bribery convention, anti-bribery action. Well, as I say, it would be very easy for the advanced industrial countries to do, just say no tax deduction if you don't make it transparent, publish what you pay. That's another example of where the bank could take a lead in an advocacy role. Finally, let me make one other comment about Alan, what you talked about, the difficulties in a place like Africa, of responding to the opportunities that globalization offers. Tom Friedman has written a very influential book called The World is Flat. In my book, I discuss a little bit this concept and point out, actually, the world isn't flat. And in many ways, it's getting less flat. And examples are international trade agreements that are more unfair to the developing countries. But one of the ways in which, and another example are new global monopolies. But a third example actually relates exactly to the issue that you raised, which is that what Tom Friedman is identifying as the major force flattening the world is technology. People can communicate all over the world. And that really has changed the topography. But you have to have technology, access to technology, you have to have the computers, and you have to have the knowledge base to participate in this. And that puts many of the countries in Africa at a distinct disadvantage. One of the reasons the gap between China and the United States, I think, is narrowing is because of this technology which they have mastered and are using, but other parts of the world where they haven't done that, the gap is increasing. And that again becomes one of the reasons why programs focusing on the digital divide, I think, are particularly important.
Thank you.
I have a question.
Sorry.
I'm sorry.
Can you go first?
Jana Madaswa from Prem. Thank you very much for the presentation. Thank you very much for the book. It was inspirational as always and provocative in a way. I would like to ask a question which may be somewhat provocative given the historical context. There are a lot of discussions now ongoing, obviously, on all possible levels on the future bank-fund collaboration. Can you share with us your views about it? And perhaps it will also give you some more opportunity to say a few words. You said that you ran out of time once speaking on the financial system and the global financial instability. Thank you very much.
Okay, yeah, go ahead. Why don't you?
Please,
Yeah, my question was about global warming. The new theory that goes around is that there is going to be global warming anyway. It's not attributed to human intervention. It's just like part of the waning and waxing of the ice ages. So whatever we do about it is immaterial. I was wondering what you have to say about that.
Okay. In terms of the second point, there are obviously potential variations in climate that have existed over all history, but there is absolutely no doubt that we are the major force behind human activity, is the major force behind what is happening right now. And what's so striking about this, as a theorist, I actually, this was predicted by physicists almost 200 years ago. What they did is a back-of-the-envelope calculation of, you ask what happens if you do an experiment of putting more CO2 in the atmosphere, these greenhouse gases, and it reflects energy back in. And what we've done is we've doubled the level of CO2 from the level that it was before, and we are now going beyond that, tripling it and so forth. They did a remarkably accurate calculation of what actually has been happening. And the computer models make it a little bit more precise, but what is so striking is how good the back-of-the-envelope calculations were over 150 years ago. So the answer is unambiguously, we are the major source of the problem. And the way to think about it is, just think about a thought experiment that what would happen if you have this one planet if if you look at a field and you put a plastic wrap over the field, it traps the heat, and people use this for growing. So it's an informal greenhouse. Just think about doing exactly the same thing, wrapping the whole world around. It's going to make it warmer. And it's not plastic we're using. We're doing CO2 and other methane, other gases, but there's absolutely no doubt about that. And it's also no doubt that there are lots of nonlinearities that we did not fully anticipate, which mean the pace of it may be much faster than we had anticipated. So that while the overall process has been well understood, there are a couple of the other aspects of it that are happening just extraordinarily fast. Let me just give you two examples. One of them is the Arctic ice cap is melting. It's also Greenland. Well, one of the effects that they didn't originally calculate was the fact that energy gets reflected off of the white Arctic ice cap. As the color changes from white to blue, because the white isn't there anymore as it melts, it's not being reflected outside, and that itself is contributing to the warming of the atmosphere because it's being absorbed by the oceans. Another example is in the tundra, there's a lot of biomass that's frozen. But what happens if it starts to warm just a little bit to the temperature at which it starts to decompose? As it starts to decompose, it generates heat. As it generates heat, it decomposes faster. And there is now evidence that in large parts of the tundra, that is beginning to happen. So these are some of the things that in the calculations they did 100 years ago, they hadn't thought about, and may have a very, very large effect. So in my mind, absolutely no doubt, it's something that we really ought to be worrying about. At the very least, and the fact that there is uncertainty, some people say that means we shouldn't do anything about it. And somebody gave me the following metaphor. It's sort of like you're driving on a road in a car without good brakes. Should you feel better or worse if there's fog comes down in front of you? The fog is like we're not sure where we're going, but we're almost sure we're about to hit a cliff. We don't know where the cliff is, but the fog makes it more difficult. Clearly, the fact that there's uncertainty should make us feel more, not less worried. And if we had another planet that we could all march over to, if this experiment turns out bad, it would be one thing. We don't have another planet. So I think the response to this risk is to take a precautionary approach. On the issue of bank fund cooperation, and some of the broader issues of the finance, what was going on in the global financial markets. First, let me say a general perspective that I held when I was here as chief economist, and I still believe very strongly, which is that there's a difference between cooperation and presenting the developing countries with a single view when there are differences of view. That is to say, a lot of the issues in economics are complicated. You know, I think I have the right answer, but some other people think they have the right answer. But what is clear is, in a lot of these areas, there's not unanimity. In a lot of the cases, the position of the fund and the bank have been that we, not only do we have to cooperate, we have to decide on a single position and present the developing countries with that position, in some cases, even as a condition of assistance. Now that seems to me wrong, and I think actually what the UK is doing of saying, you know, we won't give money unless you reduce the conditionality is actually probably helpful in this respect. If there are differences, we ought to trust democracy enough to say, let's lay out what those differences of view and leave it to the country to try to make the decision. And try to marshal as strong of argument as one can on each side of these disputes. On the issue of the funds recent activities in surveillance. One of the major things that it did at the Singapore meeting was to highlight the role, a new role, which is in surveillance of the global financial markets. I think this is an important step in the right direction. Their original mandate was really, at least as I interpret it, was ensuring enhancing global financial stability. And that means taking a look at how the whole global financial system works. And you can't do that without some kind of surveillance of looking at what is going on. So, in a way, my surprise is that it took them so long to come around to their core mission. It's clearly the right thing to do. But the question is, one has to be careful not to confuse symptoms with underlying problems. And doing something about surveillance is not enough. You have to be able to do something. And as long as they have a system where one country, the G1, can veto, if that G1 is itself responsible for the global imbalances, it's very hard to see how they will take a strong position and say, this is what ought to be done when that country has the veto power. So, as I say, I think it's a move in the right direction, but one has to keep it in a broader perspective. Yeah.
I'm a visitor today, so happen to be in here to hear you talk. Now, one of the fundamental driving forces for globalization, especially trade, has been the cheap transportation. So given we are likely to face a carbon constraint scenario in the future, what do you think of the global energy supply and prices, and how that would impact trade and globalization in general?
I think that obviously the increase in transportation costs associated with the increase in energy prices is like a negative shock to globalization. It just like lowering transportation costs has facilitated globalization, this is going in the other direction. But it's sufficiently small that I don't think it's going to have a very big effect relative to the other forces that I think are really driving globalization. The changes in the rules of the game on the one hand, and changes in technology on the other.
Well, thanks all very much for being here, and also I want to thank the Info Shop for hosting this event. I think it's really wonderful. It's a great honor for me to be here and to be able to welcome Joe Stiglitz to the bank for this discussion of his new book, Making Globalization Work. Now, very often chairs will say that a speaker doesn't need any introduction. In this case, I think you'll agree it's really true. In fact, I actually tried to think of people who needed less of an introduction than Joe to the bank, and I actually couldn't think of anybody. So Joe really doesn't need an introduction. I think many of us know him very well. You'll know something about his background, and let me just mention a few points for the form of it. He was a winner of the John Bates Clark Medal in 1979. He's held professorships at Yale, Stanford, Oxford, Princeton. He's currently the university professor at Columbia University, where he's the chair of Columbia University's Committee on Global Thought. He also chairs the Brooks World Poverty Institute at Manchester University. He was the chairman of the Council of Economic Advisors from 1995 to 1997. And in 2001, as I'm sure you know, he was awarded the Nobel Prize for his analysis of markets with incomplete information. But of course, Joe has a greater claim to fame. He was also our chief economist and senior vice president in the bank between 1997 to 2001. And Joe is still involved with the bank. He is a member of the Chief Economist Advisory Council, a little group that meets periodically to discuss strategic research issues. And really, he's a wonderful, wonderful participant. I could go on, but just to mention a couple of other things, that this book follows several other books on the global economy that Joe has written. The last, I think, is Globalization is Discontents, which has been translated into 35 languages and has sold about 1 million copies. A book on the Roaring 90s, A New Paradigm in Monetary Economics, a book on free trade for all. And before handing over to Joe, just sort of a personal comment on what a unique person Joe is. I mean, when I was trying to think about how I have seen Joe working, I sort of think of an analogy with the financial system, and that most of us are rather like banks. We take in deposits, we make a few modifications, we change the term, we change ideas a little bit, and then we come out with something which vaguely resembles what went in. Now, Joe is not like that. Joe is more like a venture capital company, as I see him. He comes out with a lot of very original ideas, many of which involve thinking about the situation or the world as it could be, not as it is. A very different model from the model of a bank. And I think, naturally, not every venture capital investment has to be successful. And many venture capital ideas will be controversial. And so Joe, of course, is controversial. And I think that's the great merit of having someone like Joe to come and speak to us today. So without saying more, let me hand over to Joe. Joe, thank you.
Well, thank you very much for that introduction. And it really is a real pleasure to be back here. And especially talking about this book, two of the critical issues that I talk about in the book are really at the center of the concerns of the World Bank and have been for a number of years. Problems in globalization, governance of the global economy, and problems of inequality highlighted, for instance, in the WDR of a little over a year ago. The title of the book, Making Globalization Work, provides, in a sense, a short summary of the whole book. The statement, Making Globalization Work, first suggests that something is not working right now. And as many of you who know me know that, yeah, I don't think things are working perfectly. And I'm going to spend a few minutes talking about some of the major ways in which it hasn't been working, particularly in areas of economics. The second is a note of optimism that there are changes, reforms that can make globalization work, or at least work better, and particularly work better for the poorest countries and for the poor even in the more advanced industrial countries. Because while globalization has had some winners, it has also had many losers. And much of the concern in this book is about the impact that globalization has had on inequality. So the book, and we as economists think that we've been doing a lot of research for the last 25 years or longer, and therefore know more about how to manage economies. And in spite of the fact that as our advice gets listened to, there are better market institutions around the world, actually growth hasn't been doing that well in developing countries. The region of the world that has perhaps paid the most attention to the, quote, advice coming from the advanced industrial countries has been Latin America. And Latin America in the 90s grew at a pace just over half of what it did in the 50s, 60s, and 70s before they learned how to manage their economy. In the case of Brazil, the numbers are, of course, more dramatic. Brazil had growth of 5.7% for 75 years before 1980. Now, they're happy if they can get 3% growth. And one of the saddest things that I've seen is the lowering of aspirations, of expectations, as a result of this, if now almost a quarter century of modern globalization in which growth has not been up to what one would have hoped. By the same token, one would have thought with greater knowledge, better market institutions, there would be fewer crises. But in fact, as research here at the World Bank has shown, there have been about 100 crises in the last 3 decades, that it's more unusual for countries, developing countries, not to have had a crisis than to have a crisis. The only major emerging market countries not to have had a crisis were India and China, both of which did not go along with the standard wisdom of capital market liberalization. And one would argue it was because they didn't go along with that they did not have these crises. There are other aspects in which globalization is not working in the way that economic theory would have, one would have expected, the advocates of globalization had predicted. If you saw a world in which water was flowing uphill, you'd say something's very peculiar about that world. Well, in economics, the same thing. If you see money is supposed to flow from rich countries to poor countries. But in recent years, money is often moved from the poor countries to the rich countries. And that's part of the reason why growth has not been as strong. One of the reasons that money has been flowing from the poor countries to the rich, and they have not been doing very well, and there has been a divergence. And we see that even closer to home, there's been a divergence between the United States and our immediate neighbor to the south, Mexico. I was on the Council of Economic Advisors at the time that NAFTA was adopted, and while we thought NAFTA would have a relatively little impact on the American economy, the major argument we thought for NAFTA was that it would help Mexico, and that by helping Mexico it would reduce immigration pressure on the United States, and that would have some positive effect on the United States, which we anticipated. Immigration, illegal immigration, was already a growing problem. Well, 10 years after NAFTA, it's clear that rather than reducing the disparity between incomes in the United States and Mexico, those income disparities have increased. And I try to argue in the book that actually NAFTA was at least part of the reason. And it's particularly had an adverse effect on the poorest people in Mexico, because the United States retained, it was called, NAFTA is the North American Free Trade Agreement, but it's not a free trade agreement. That was just the name. If it were a free trade agreement, you could write down a free trade agreement in a couple pages. You say, no barriers to trade and no subsidies. It take maybe 2 or 3 pages. Those of you who have seen these international free trade agreements know that they go on for thousands and thousands of pages, so long that no one is able to read them. And that actually gives enormous opportunity for a lot of the corporate interests to stuff a lot of things in there, knowing that no one will actually read them until it's too late. And if I have time in the question period, I can give you some very dramatic examples in the case of NAFTA's Chapter 11 on investor protection, which was actually designed to reduce the scope for environmental protection. But one of the aspects of in which the NAFTA was not a free trade agreement is that America kept its corn subsidies. These corn subsidies reduced the price of corn by about 50%. The poorest people in Mexico are the corn farmers. So in effect, NAFTA reduced the income of the poorest people in Mexico by 50%. And no wonder then that it actually resulted in increased immigration pressure. In spite of the fact that the way consists of first identifying some of the problems, diagnosing why we have such problems, diagnosing this from both the perspective of the macro picture, the overall international architecture, and from the micro picture, looking at the particular arenas, trade, intellectual property, natural resources, global financial markets, the environment. And then finally, on the basis of that kind of diagnosis, to try to come up with some prescriptions, some ideas, some small, some large, some that can be accomplished, I think, in a relatively short time, and are, I think, really in which there's already some progress, and some I think that will take a little bit longer. Let me begin by talking about some of the problems. The in the beginning of the discussion, of the modern discussion of globalization, maybe 15 years ago, there was the hope that everybody would be better off. There was a view that sometimes put that a rising tide lifts all boats. And one of the sub-themes of this book is that a riptide can destroy a lot of small, ill-prepared boats. And that sometimes the way globalization has been managed is more akin to a riptide than a slowly rising tide. In fact, there's been a divergence between the most successful countries and the least successful countries. Inequality across countries and inequality within countries has been growing. And that globalization has played a role both in the successes and in the failures. Successes sometimes get overlooked, particularly by critics of globalization. I want to emphasize that there have been some enormous successes. China has been growing at 9.7% for 30 years, India at 5 to 6% for a quarter of a century. These are countries that have managed globalization, at least managed it relatively well. In the case of China, several hundred million people have moved out of poverty, even though there has been increasing inequality. Their successes have largely been based on globalization, access to international markets, access to international technology. At the other extreme are the countries at the very bottom.